I talked to the brightest minds in the investment industry to find out the odds of recession and to determine how investors ought to position as a result. I explained why I was asking the question in the first place in a piece called Is Recession Coming? Let's pick it up where I'm taking a close look at ECRI, which is a weekly data series that I use to determine the economic strength of the business cycle. So you see the chart here of ECRI with quarterly GDP, and you can see how well correlated it is. It's indicating that we've got some weakness to come. Okay, so that's the first interesting point. Then I like to put the ECRI against a number of other indicators that may be forward-looking. And this is where it gets interesting. I'm going to show you a whole series of charts now for you to look at. So this chart is the CAS Freight Shipments Index. You can see how dramatically freight shipments have fallen and how much they're suggesting that the ECRI could fall from here and therefore the GDP as well. Car loadings, a similar way of looking at transportation, it's collapsing. Capital goods orders, these are the big ticket items, the things that a lot of times you use financing for or are involved in the global supply chains. You can see how they are rolling over as well and following ECRI lower. If you believe in this supply chain story, and it seems to be bearing itself out in the press almost daily, then you've got to imagine that capital goods orders are going to come lower. But households are also struggling with the rates. So you've seen that in how much car sales have fallen. So car sales have languished and they're expected to go further. Clothing sales have collapsed in recent months as well, which has been an extraordinary move. And restaurant sales as well have been extremely weak. So you're starting to see not only is shipping and moving goods around weak, but you're also seeing a weakness in the consumer and a weakness in business expenditure. Another great global indicator I've looked at is semiconductor sales. Semiconductor sales are extraordinarily weak right now, and they too are suggesting the global business cycle has a lot further to fall. Back in the US, we've also got the housing cycle. It looks like that the Case-Shiller House Index is starting to weaken significantly and is now at the weakest level since before the previous recession. And we also have weakness in house prices overall and construction. So I'm concerned that all parts of the economy are showing evidence of weakness. And I know many people say, well, unemployment's not. Unemployment's strong. Unemployment, interestingly enough, is the most lagging of all indicators. And just remember that every time the Fed cut rates and unemployment was below 4%, we went to a recession almost immediately afterwards. They're all lagging. So don't get trapped in the unemployment. Look at the forward-looking indicators, and they're looking problematic. So that's what I found in the US. Then I took a look at the global data and found even more signs for concern, particularly around Europe and China. That's how I determined that based on the data, the whole world looks to be rolling over at once. Now, some of you might be thinking, so what? It's about time we had a mild slowdown. But there are two major issues here, debt and demographics. It could lead to a massive adverse event that I refer to as the doom loop. I know it's dramatic, but here's my summary of the chain of events that we could see. Phase 1, the business cycle weakens. Credit begins to widen, corporate cash flow worsens a tad, and shares fall and volatility increases. I think that's where we've got to now. I think phase 1, we accomplished, and it started really in about October. Phase 2, the business cycle weakens again. Credit widens more, cash flow gets worse, as do profits. Tax receipts fall, and state pension funds stop buying debt. Big BBB stocks fall, and bonds fall even more sharply. Equities fall hard. So I think this is the next phase, and I think it's coming after the summer. We'll wait and see. My forward-looking indicators suggest that Europe has a SESI upcycle right now. There's a bit of stabilization of data. I have a feeling that if I'm right about the debt ceiling or the dollar breaks higher, then I think we're going to start to see phase 2 come in. When we start seeing phase 2, we know where this is going, because then the story becomes very clear. Phase 1 was the alarm bells. Phase 2 is strap yourselves in. Okay, let's go on to phase 3. This is when things get ugly. The baby boomers start to panic to get out of equities permanently. There's downgrades of BBB to junk. The EU banks can't take the funding stress, and the ECB and the government step in. Credit spreads explode. Credit seizes up entirely as pension funds have forced sellers on downgrades. Equities go into tailspin. There are no natural buyers. Credit widens dramatically. Offered only, no bids. Junk bond market overwhelmed. Pension funds get into trouble, defaulting on obligations. Big, famous companies are being forced towards bankruptcy unnecessarily. That's the really ugly phase. And that's the one where I think many of us have got a sense that there is an end game that's at the end of all of this. If there is one, it lies in the heart of that. Whether we get there or not, it's going to be a function of what the Fed does and what the central banks do and how they deal with this. And there's many outcomes for that, and it is not going to be a straight battle. But all I do know is these things tend to accelerate much faster. So now that we know just how much rides on the recession question, let's try and get some answers. Straight off, I talked to Lakshman Atushan, who is the co-founder of ECRI. He was really helpful in helping me interpret exactly what the data was saying.
The way I would sum that up vis-a-vis, like, is there a recession somewhere on the horizon, is that we're slow walking toward a cyclical window of vulnerability. Mm-hmm. Now, many people think a recession is the result of some shock. You know, somebody did something wrong or something happened that nobody could have predicted, and that's why there was this recession, some negative shock. And that's not how recessions are made. We've been studying this for longer than I care to admit. And the way our basic, the crux of our finding is that there's an endogenous cycle, which is being tracked by good cycle indicators, including leading indicators, which can tell you if you're in a downturn or an upturn. Now, we're in a downturn, and we're looking at the forward leading indicators to see how that downturn is likely to progress. If we begin to see a window of vulnerability opening up, which would mean that our indicators are falling in a much more pronounced, pervasive, and persistent way than they are currently, then virtually any negative shock, any of the things that have occurred over the last half a year, can become a recessionary shock.
When I talked to Teddy Valet, he echoed that point about a window of vulnerability. Do you think the US goes into recession?
It's a tough call. Given the information we have, if it does happen, it would happen from now to June next year. There's never been a higher probability this cycle for the US to go into recession because, one, we've had a tightening cycle. 2015-16, we never had a tightening cycle in the US. It was just a China drag. Yeah. Now we have a tightening cycle and a China drag that's really pulling down the data, and we have not seen it pick up.
And trade tariffs.
And now you have the trade coming in.
Perhaps this window vulnerability idea also helps us make sense of some of the recent central bank policies we've seen. In fact, according to Christophe Oliari, the Fed and the rest of the world central banks are doing anything they can to forestall a recession in this tender moment.
We are going into that downturn with official rates in low twos, two major central banks with negative interest rates, 14 trillion of balance sheet. So basically, the ability of the central banks to answer the way they did it in 2008 is very limited. The problem is they can't afford the burst because they don't have the meaningful tool to address the consequence of a massive downturn. So they will need to be very preemptive, and I think that this is the message we have this year. I think they have no illusion about their ability to kickstart the economy. I think they have no illusion about their ability to boost real inflation. So these mandates are quite an illusion. So they are focusing on what they can do, which is keeping the financial conditions as loose as possible.
And because Oliari believes that markets are in a massive bubble, the stakes are especially high. And as a result, central banks could pursue increasingly extreme stimulative policies. And since these policies may work in the short term, Oliari actually believes that a recession is not particularly likely right now. So what's an investor to do? Well, for Oliari, it's pretty simple.
I've never been as bullish as in the past on gold. I was bullish when we met in March, and gold was trading 1,300. I still believe that real yields will go further lower, and I still believe that because you're going to have so much cash injection, plus a currency war between all the central banks trying to put pressure on their respective currencies. So you have a risk of debasement of the fiat currencies. I think the gold has got a golden mix in front of it.
So Christoph thinks that central banks will destroy the value of their currencies, allowing the price of gold to rise. It's a pretty compelling case, and even though he and I might disagree about the economic outlook, we do agree that gold is a good way to play the central bank's next move. Greg Weldon is also in on the gold trade, but he's looking at it more from a technical perspective, and that was really interesting.
So the long-term picture is then, here's your correction. You had A, B, C, Fibonacci, and you're rolling back to the upside. Well, this is basically 1, 2, 3, 4, 5, typical Elliott wave dynamic where wave 5 has just been ignited. We talk about ignition, and here we have liftoff in gold. So how do we want to play that? Well, if you're not long, any retracement down into this, you guys, you get below 1,300, you get like a 1295 print. It's a gift from the gold gods. You got to back the truck up in that case. I don't know that you're going to see that. I don't think you'll get much below 1265 to 1260 if you get a dip. Because this is a longer term breakout. So 1345 would be kind of a last gasp on the downside. And then, frankly, you get below 1290, then we're wrong. And then 1266 at risk. But I really don't see that happening. Not when I see stuff like this. And here we get to the trade. Finally, yes, right, to the trade. All right, the GDX gold mining ETF. Really like this here. It is now breaking out. Look at this pattern. It makes new lows. This low is so unconfirmed by any technical, momentum indicator you want to throw in. You got the breakout. You got the retest of the trend line that was violated. I love this pattern. 30 years in doing this, I'm telling you, it's one of the most reliable patterns when you get a long-term trend breakout, and it kind of seems like it's running out of steam, and it comes down. It might even make a lower low, but it holds above the violated trend line. That's huge. That retest on the backside, particularly when it lays out right in the zone between the 50 and 61% Fibonacci retracements. In the meantime, you get back over the 2-year moving average, which is now accelerating to the upside and making a new high in line with price, a very bullish dynamic. And this is long-term stuff, man, here. Look at the 52-week and the 2-year moving averages crossing over here as well. Very bullish. The GDX would be the trade here, in terms of what trade we're putting on here, one of them. GDX would be an option, and frankly, you just plow right in here because the risk reward is still quite favorable.
So playing a slowing economy and increasingly accommodative central bank policies by buying gold could certainly be an option. But I think there might also be a simpler way. In this Recession Watch coverage, we had the great pleasure of hearing John Burbank, who to me is one of the greatest living hedge fund managers. He discussed his highest conviction trade with my good friend Alex Gurevich, another well-known hedge fund manager. Burbank also thinks that the Fed will cut rates much faster, much further than the market currently expects. He thinks they go to zero, but he prefers to express that thesis by using Eurodollar futures, since those track the short-term interest rates on US dollars. They're highly influenced by what the Fed does.
What I like about betting on with Eurodollars and betting on Fed futures is that we're betting on where the actual policy rate is going to settle. It's like betting on the earnings, it's like nailing the earnings of an equity, but not having to worry about the multiple.
More specifically, Burbank is talking about buying options on Eurodollar futures, and he's not shying away from this trade either.
I'm talking about like getting a 10x return in a scenario. And so in a way, I'm like bringing a risk-seeking mindset to this trade for a lot of people who aren't used to having this maybe optionality or aren't seeking this kind of risk. I now can understand why Druckenmiller could have made so much money, in these times, right? A risk-seeking mentality in an incredibly liquid, leverageable, area. I get it. I get that now.
Someone else looking for a massive return is Dan Tapiero. Dan is known as one of the sharpest minds on gold and macro in general, but recently he's been increasingly interested in what some call digital gold.
Bitcoin is a lot of things. So what it is it's an invention, and I think it should be referred to as an invention rather than all the other things. It's what it really is it's a truth machine. It's a way, in a way, to eradicate all fraud or, lying by human beings. The whole, bigger concept of certainty, of confirmation, of validity, of security. That's what you're buying. A system that, now is 10 years old, has a tremendous track record. And I'm thinking, well, what's that worth?
When I asked Dan his own question, here's how he responded, starting first with the market cap of Bitcoin and then discussing other people's predictions of the price per coin.
It's now $200 billion in market cap, but that's kind of small. You know, it's kind of small if you, not even if you just see what's been built. Like, you know, it would cost more than $200 billion to build that, right? So you can start to think that, you know, within 10 years, the Winklevoss $1 million or Draper's $250,000 in the next few years, it's not unreasonable. And so what is the bet? The bet is to buy and to do nothing else. That's it.
I'm also interested in Bitcoin because I think it could be a way to play this doom loop thesis of mine from the bullish angle. And part of that thesis, by the way, comes back to China. China has been the growth engine of the world, and that engine appears to be sputtering. Russell Clark has noticed that as well. And in this conversation with Roger Hurst, he outlines a specific chain of events that basically ends in economic disaster, and it's playing out in front of our eyes.
The problem is that when you combine those three things I've just told you, low liquidity, huge derivative notionals that don't match up to that liquidity, and then the delta in markets being by trend followers, when you combine all those different pictures together, what that suggests to me, together with issues in China, is that you get a gap in the market. That is, so one day we all go home on Friday, and over the weekend the Chinese go, oh, that's it, may as well, we're going to rip the Band-Aid off, and we come in and the renminbi is at 9, right? And equities then open up down 15 on a gap, right? And then, of course, in vol, suddenly goes down at 40 or something like that. The problem then is that this huge amount of derivatives that suddenly get knocked in, and they're looking for liquidity. And one thing I've also seen is that the high-frequency traders that provide most of the liquidity, they pull their bids on vol spikes because they're not programmed to think. They're just programmed to react to market prices. So when they see vol go low, bids get tighter. When vol goes high, they pull the bids. And this has been the problem. The problem of that view is that what that means is you go one way to pull all the CTAs long, and then you go back the other way in a gap.
So to put you on the spot, to sort of round it off, your view, and part of your view is that you believe that the renminbi will move through 7 and they will do something, and this will trigger a whole series of chain reactions. Is that going to happen before the end of this year?
When you look at the sort of dichotomy between, like I said, macro indicators and what equities are doing, the macro indicators are saying that, get positioned for it now.
Josh Wolfe, one of the smartest and most successful folks in the venture capital space, is looking at liquidity as well. He believes that we may all learn exactly at the wrong time just how little liquidity there really is.
You have the illusion of liquidity because you have daily trading and ETFs, and they're marked on a daily basis, but the underlyings suddenly might be illiquid. And so I think that there's a real risk of permanent impairment, which is the true measure of risk of principal. So if that happens and retirees start saying, wait a second, you know what, let me go to cash. Let me get out of these bond funds that I thought was safe. That creates a problem. Well, they also might need to sell out of equity funds.
But to me, it's not enough just to look at the macro. You need to get your hands dirty and really investigate some of the specific sectors that matter the most. That's why I spoke to 5 sector experts so I could see how they're making sense of the economy through their own specializations. I traveled around the world via Skype and found about metals, chemicals, shipping, autos, and real estate.
So for sure, the bigger story is trade and trade tariffs. And that was an unexpected development that many, particularly industrial customers, hadn't come to appreciate. I think the seriousness with which the Trump administration was approaching that topic. They had been used to a breakdown of barriers, not imposition of barriers. And when the industrial world all of a sudden had to contend with, in particular, tariffs in China and having to deal with tariffs on Chinese fabrication products and Chinese exported products, that was an unexpected change in supply chains that I think people weren't prepared or had forecasted to deal with at all. So that to me has been the biggest story when I talk to business customers and people that move goods around the world for various final fabrication, intermediate processing in different places. That to them was a major reorienting of the supply chain they had become used to, where China is a major importer and exporter of a number of commodity products and intermediate products, from electronics to steel products to auto parts and other things that touch China as in numerous amounts of goods, that all of a sudden became quickly uneconomic, and that wasn't forecasted. I think we're due for a period where we do see business activity contract, and we do see a bit of a pullback, and I think we're overdue for that. And a number of industrial leaders, leaders, CEOs of big companies involved in our industry, they recognize that.
What we've seen since December 2017 is a definite slowdown in the chemicals industry. And this matters because we are the third largest industry in the world after energy and agriculture, and we go into all parts of the economy. And we're in that position in the value chain where we do get 6 to 9 months lead time on what's happening elsewhere. So and then if we start to focus down a bit, one of the wake-up calls for me was October last year, where there's a big industry conference in Europe, and I walked into my first meeting with some senior people from a major company. Said, how's business? Always my first question. Oh, we were down 40% the second half of September.
Wow.
Ooh. I said, oh, that's, and, went through the 3 days. We had 20 odd meetings with companies, not just European companies, but global companies. And one CEO joked halfway through and said, oh, no, actually, we're doing better than everyone else. He said, we're only down 20%. Now, I don't want to sort of say, this is a collapse. What I'm saying is that marked the moment at which we transitioned from a stable, slightly rising picture towards a real significant downturn. And so if we come back, we've now got the May data from our friends at the American Chemistry Council. And normally May would show quite a sizable improvement because it's right in the middle of the second quarter. So car sales should be going well, construction should be going well, all of these things. The weather has been good, was good in May, but in fact, it only bounced by 0.2%. That's less than half of what we normally get in May. So what we're seeing is a deteriorating picture in the industry in almost all of the major markets, and the bounces, and this is something I look at a bit, the bounces are weaker than they used to be, and they're getting weaker all the time. So the outlook for the second half of the year isn't terribly good, I don't think. We're virtually on the point of saying we are either in a recession or about to enter a global recession.
So starting at the global level, total global vehicle sales are down about 6.4%. This is kind of morphed into like a every market phenomenon, and it's very concerning. It's starting to have ripple effects on not just the automakers, but the suppliers. And I think the phrase you use often is there's quite a bit of knock-on effects that are yet to be seen. But some are starting to filter through. The best way to describe it is we have not begun the healing process. So
you're seeing your short-term indicators are down. Your medium-term indicators are indicating an acceleration of weakness, and your long-term indicator is not showing any pickup into the extended future yet. Is that right?
Correct. That's correct.
So this is quite a large bust coming in the car market. If we're not seeing, it looks more than a short-term cycle here. It's not an inventory cycle. We've actually got a bigger slump.
Absolutely. And that's a great point, because we can go through ups and downs where inventories get out of hand, production gets cut, all of a sudden day supply looks good. And 3 or 4 months later, we're back in the same boat. That's just how it happens as the market continues to weaken over time because of headwinds like time to equity.
Global macro, I'm seeing similar things you are. The world trade seems to be slowing. On the demand side, we're going to have to see what happens. The trade war obviously has multiple drivers, and shipping isn't this monolithic thing. People love to look at the Baltic Freight Index, but there's many different categories of shipping, subsectors. So when you look at something like containers, demand for Chinese containers going into Los Angeles is slowing. But when you look at other things like Baltic Freight or crude oil, anytime you have trade wars and trade disruption, it means that the number of vessels on the water have to go further, and the number of ton miles increases. Take the situation with Venezuela right now. It used to be that America imported a lot of Venezuelan crude. That's now all become circuitous, where Venezuelan crude goes somewhere else, and then eventually usually comes to America. And Venezuela, which was importing refined product from America, is not directly importing it. It's going somewhere else first. So what that's doing is it's increasing the shipping routes, and it's increasing the number of ton miles, and it's actually buoying prices, even though the global economy and world trade, and especially indexes you look at like cash shipping index, are showing serious declines. It hasn't yet hit shipping, and if anything, I think shipping is doing quite well.
Right now, for example, there are some serious red flags out there that, if I could just briefly run through them, I think they're important. For example, home sales have been weakening in even the hottest major metros for a year or so. Some of them, most of them are down double digits. Now, slowing home sales by itself isn't necessarily a problem, but combined with that, you have the rising inventory of homes for sale. 2 months ago, it was in the hottest market in the country, Silicon Valley, San Jose, was double the inventory of a year ago, and it's still up substantially. The other hottest markets, Seattle, Denver, LA, are all showing pretty substantial rises in inventories. You put those two together, and that it suggests to me that we're going to see, and we have been seeing, increases in reductions in home prices.
Finally, at the end of these 2 weeks of programming, I talked to one of the most respected people in the entire investment research landscape, Kiril Sokoloff. When I sat down with Kiril in upstate New York, he kept bringing in historical examples to make sense of the present situation. It's an interesting approach and one that has really yielded him incredible results throughout his career. Here's how he responded when I asked him the recession question.
Well, the great question of our time is whether this is a mid-cycle correction like 95 or 98 with the Fed easing into a recovery, or whether it's recession like 1989, 2001, or 2007. And I have a very hard time seeing that this is 95, and I can go into why I don't think it is. I'm totally agnostic. I'll let the market decide for me. But all the evidence on economic data and, above all, confidence and trust, because this is really a confidence and trust issue. How are you going to put confidence and trust back into the picture? You've done a savage cutting on that. I cannot believe it's possible for trust to be restored in the next year and a half. Just impossible.
So how do you rebuild trust?
It takes years, decades. It's extremely significant.
So your sense is that we may be at a cyclical turning point, but we're actually this is a secular turning point as well in many respects.
It could be. If the U.S. goes for protectionism and the rest of the world were to follow, it definitely would be a secular turning point. If the U.S. goes for protectionism and the rest of the world doesn't follow, it won't be quite as bad. But then you have the whole cycle of wealth distribution coming, and how's that going to play out? And if Trump doesn't get reelected, what then happens to all of the deregulation and tax cut, all the things that he did to get the stock market up? Will buybacks be outlawed? I mean, there's so many things that could happen that are a significant watershed event that the market isn't paying any attention to, but is a significant risk. And then, of course, you have what I call the burden of the debt, which might be the reason why it's so hard to get growth. And the last time we tried to do economic growth with more debt, solving the problem of debt with more debt, was in the 1920s. And we know how that ended up. So we got 250 trillion and counting of global debt, which is more than 3 times global GDP. We've added debt at the rate of, depending on the country, 1.5 or 2 times more than nominal GDP in the last 10 years. So we've leveraged up the system, and maybe the burden of debt is just too great to grow. And even though interest rates are low, a lot of the debt was used for unproductive purposes, so it's not generating any cash flow. And then, of course, you have demographics, which until recently the U.S. was a hopeful spot, and now is almost as bad as others, with the population growing at the lowest rate in 80 years this last year. So if, in fact, it is the beginning of recession, it has immense implications, which is why I'm glad you asked me the question. And the first is, will the recession be over by the election? And the second is, how will this impact China-US trade relations? Mm-hmm. These are very, very significant. So my hunch is that President Trump wants to run on tariffs and wants to run on protectionism and taking on China. And even if the economy were strong, he would do that. But if the economy gets weak or recession, he will double down. He's certainly not going to say, I'm in favor of free trade and take all the tariffs off everywhere. It's not going to happen.
The tariffs aren't going away.
Yeah.
No.
So that means protectionism. And then the next question is, what does the rest of the world do? Do they put up barriers? And that's probably the most important question of all, because that's what happened in the 30s, where everybody went protectionist and beggar thy neighbor. And of course, you've got some very large export economies, China, South Korea, Japan, Germany, very important to the global economy. I fear we're on a slippery slope here. And when you open up the protectionist mine chute, you can't bring it back. And there's a guy named Jude Wanniski. He's since passed away, but he was one of the original supply-siders, along with Art Lafter and Robert Mundell and Bob Bartley, editor of the Wall Street Journal. And he gave me his book and wrote it to me to Kiril, a disciple of the supply-side revolution, 1978. And he wrote the book because he wanted to disprove that it was free market economics that caused the '29 crash and the Great Depression. And he plotted how the Smoot-Hawley tariff made its way through Congress in the fall of '29 and how the stock market reacted to each support or against. And finally, when it became clear it was going to happen, that's when the crash happened, or happened for real. So he makes a very good point. But having seen that and knowing that history repeats, I have this gnawing anxiety that we could be going down that same slippery slope here.
So Kiril's head is in a similar place to mine. But what I find so fascinating is he's always trying to see sense in the larger secular turns that are happening in the background of these economic cycles.
We need to add into this my view that we're entering the cycle of from wealth distribution, from wealth accumulation to wealth distribution.
Right.
And it's as old as history. It's been going on for thousands and thousands of years. Julius Caesar canceled debt, for example. And there was a debt jubilee in the UK, I think in the 18th century. And probably in the history of man, there's never been a period of greater wealth accumulation. I don't see it as socialism per se. It's just a cycle. And if we put that into the picture here, this means that corporate profits are going to be hurt because labor is going to take a greater share of the pie. Has been going down for 40 years. So that would obviously impact the stock market. I happen to like gold a lot. Mm-hmm. It's been out of favor. It's not understood at all. People come to it very late in the cycle and they ride it up and they think they understand it when they really don't. It's a very sophisticated instrument with much different values and trading parameters than people are experienced. And I see it as the best barometer of deflation and reflation. Mm-hmm. I'm not using the word inflation, reflation. Now, at the end of the last commodity cycle, or I should say the one in the 1970s, gold and all the commodities went up because the dollar was very weak. We may get into that kind of a period. So I think right now gold is very attractive. Obviously, the mining shares are attractive. I certainly think having liquidity is very attractive. People think that there's so much liquidity and so much cash. And I've seen so many times when there's too much of something, it becomes not enough.
Now, when you hear different people use completely different frameworks to make similar points, you know you might be onto something. So there you heard from Kiril about political upheaval, about issues for equities, about the troubles with liquidity, and about the case for gold. And I think he's bang on. So where does that leave us? Well, obviously, we'll see how it all shakes out. But there's one point I don't want you to miss, which I made in my last video for the series. You might reach different conclusions, and that's fine. Again, I've always said there are no certainties in this world. All I'm trying to do is corral all the information you could possibly need to make an informed opinion, because being ahead of the crowd, taking the opposite opinion to what you think the market's thinking, is where you make the real money. You can jump on the trend later, But first, this is the turning point that matters. And I think the turning point, or the returning point, with the bond market yields falling, is upon us again. And I think the opportunity to make a lot of money is coming up rapidly. So I want to thank you for coming along with me on this journey. If nothing else, I hope it's helped you understand why this recession question is so desperately important. For Real Vision, I'm Raoul Pal.